there is another concept of general reserve. Now what happens once the company has made a profit, taxes has been paid, what is remaining? The option is, one, you can pay some amount to the shareholders as a dividend, as we have explained and talked about it before. But before paying dividend, the company may think, should I not also, as a matter of prudence, at a matter of long term thinking, create from this amount rather than fritter it away and again create something out of it for my long term use. Say for example, I may need to replace my plant and machinery from time to time. So can I create something called a plant and machinery replacement reserve? Now this is an example of what is called as a general reserve. So from the profit after tax, certain amount is earmarked, moved out, taken for purposes like this, and they are not therefore meant to be paid out as dividend. The idea is, for future expansion, for future growth of the company, certain amount of money, certain amount of funds need to be moved out and kept from the profit after tax, and therefore that sort of a reserve when you create, okay, is called as general reserve. The idea is not to distribute them as dividend or share that amount with the shareholders, because the idea is that you need it for the long term growth and long term sustenance of the business. So that is called as a general reserve. So general reserve is something that you first move out, and then after that certain you decide how much dividend has to be paid out. So dividend, as I said, after moving out your general reserves, you will have the balance amount available for appropriation, as we call it, to be paid as dividend, and the payment of dividend is a management call. Now should it pay at all or not is something that the management decides based on the cash flow position of the company, as well as future prospects of keeping this money back, what kind of return it can generate, how much would be the requirement of cash for shareholders from time to time, so that some cash is also paid out to them, etc. The number of considerations that go into it, and companies sometimes even declare what are known as interim, that is during the financial year. Normally in India, the financial year is from 1st of April to 31st of March of the next year. So there may be companies who, after the September results, that is half year results, may declare some dividend as a matter of appreciation of having done well, etc., and want to reward the shareholders. Such dividend which are paid during the accounting period are known as interim dividend, and then at the end of the year, assuming that the performance continues, they may pay one more dividend, which is also called as final dividend. As I explained to you before, dividend is nothing but appropriating a certain amount of profit after tax to be paid out to the shareholders in cash. The way you look at the dividend is, say if here in this case we paid a dividend of 2,50,000 rupees, you can say that 100% in respect to the nominal share capital. So if the share capital is 2,50,000, you have paid almost the same amount, so it is 100% dividend paid, or 1 rupee per share. You can also say that it is 1 rupee per share in relation to number of shares. This is some of the ways you express the dividend paid out. So now let's look at this retained profit reserve in totality. It's also sometimes called as revenue reserve, retained earnings or profits, undistributed or unappropriated profit, P&L account, etc. Number of ways to look at. Basically it says what is the profit. It's basically an appropriation of the profit after tax. It says what is the profit after tax, how much dividend are we paying. Out of this there will be some general reserve, as I said, some specific long term points of view like plant and machinery replacement, etc. We might want to move from the profit after tax a certain amount. So what is that amount I have moved out? What is the dividend I am willing to pay? Out of 3,50,000, 3 lakhs will be moved out, one as part of dividend, other as part of movement to general reserve. The balance is what I carry as retained profit reserve. I keep this reserve for a future use if necessary, for purposes which are not specifically earmarked, like in case of general reserve. So the general reserve amount now has 50,000, and therefore the total shareholder funds, when you add up all, comes to this amount. of 8,50,000 rupees. So, why this movement? As I told you before, this general reserve idea is to make sure that for specific purposes the company has earmarked money for from their profit after tax, and that should not in any way be distributed to the shareholders, because it is for the long term sustenance and growth of the company. So, say the next year the company made a fairly lower profit of 1,25,000. Now, it needs to move to the general reserve as a matter of policy 50,000 rupees. So, what is left to be paid out as dividend is 75,000 rupees. Now, if the company does not want to pay such a low dividend, the best it can do is to again take what was already lying as 50,000 rupees in the revenue reserve or the profit and loss account, add that to the current year profit which is available for payment as dividend, and the maximum it can pay is the amount of 1,25,000 rupees as dividend. Now, idea is that this reserve of retained revenue reserve or retained profit reserve can be used for purposes such as this, which is when you make lower profits in that year to augment your dividend, or for purposes which may come about later and there is no specific purpose attached to it, which then can be useful from either the shareholder point of view or the company's point of view. So, this is how the overall reserve. So, we saw there was a shareholder part of it, there was a capital reserve or the share premium part of it, and there is something called as a retained profit or reserve part of it, including general reserve, which has specific purpose reserves, adding up to giving you what is known as shareholders fund or owners equity, and it is quite different in that sense from how a proprietor's capital account or capital representation in the balance sheet will look like. So, when you look at a balance sheet, the company would normally provide what is known as statement of movement of reserve. In India, till recently this was being provided in the form of what is known as an appropriation from the profit and loss after tax, which from the current year, which is 2012, is changing, and now you have to show that as a movement in reserve in this format, more or less, which is to say what was the year beginning position as far as share premium was concerned, the amount in the general reserve and amount in the retained profit, what was the profit after tax made for the year, and from the profit what was the various appropriations done. To the general reserve 10 was transferred, dividend paid was 60, so transferred to general reserve is plus 10, out of retained profit is minus 10, and the share, a further share was issued for which some premium was collected, which is 500. This is adding up to the end of year position of share premium becoming 5,500, general reserve becoming 760, and the retained profit, which is a general reserve available, a reserve which is not specifically earmarked, available for other purposes at a later date. This is how the presentation of movement of the reserves is to be done. If you look at the old sole proprietorship discussion that we had previously, we showed that the ownership interest is nothing but the net assets, that is all the assets less all liabilities. Once you reduce it, whatever remains, that net assets is the ownership interest. Now, in this context also, if you look at net assets, will be nothing but assets of the balance sheet less the liabilities. The other way, if you look at this equation, is to say that this total shareholder fund is also share capital plus reserves. So, share capital is this plus reserves gives you total shareholder fund, and if you combine this with the previous equation where we said shareholders funds is equal to net assets, which is capital is nothing but owners capital is nothing but net assets, we can rewrite this whole thing as what, instead of share capital we can say instead of shareholders funds, we can say it is net assets. So, the shareholders funds will be replaced by net assets. So, net assets minus share capital will give you the reserves figure. why we have put this into place is just to understand that if the share capital of a company doesn't change, that is once it is issued and remains stable, then the way the reserves move, the reserves is nothing but a function of how the net assets, that is the total assets less liabilities. The faster the rate at which the assets grow compared to the liabilities, the more the accrual towards reserves is, the higher the accrual accretion of funds for the shareholders, which are available in future for expansion purposes of the company as well as for shareholders benefit. So that is how this the way we have to look at is that the reserves accretion is happening because of a change in the net assets of the company, assuming share capital doesn't change, and change in net assets of the company would definitely happen as the profits generated, because of which the assets that get created are growing at a much faster rate than the liabilities, thereby creating greater and greater reserves for the company.